Norm Pappous, welcome to my show.
Hey, John, good to see you again. Hope all's well. Thanks
Yeah,
for
well,
having me on.
I'm delighted. We've known each other for the longest time. You've been on Wall Street, you had a long and varied career overseas and in the US. You've been a financial advisor. You've covered the gamut. Just tell us a bit about yourself because you've a new book out, which we're going to dig into in a few moments. And it's a personal story on many levels, but it's about what you see as a kind of a grand corruption on Wall Street, and you're not bashing up the practitioners as a mass group, but you have a lot of bones to pick, a lot of financial bones to pick, and it's eye-opening stuff. Tell us about your background, and then we get into the book.
Sure. Well, I started out in the futures markets, much like the last guest you had, and we sold futures products. I was in the 72nd floor of the Sears Tower, which is really nice in Chicago. Went back, got a master's degree, and I started working for institutional clients after I moved to London. Worked for some investment banks over there, a old venerated merchant bank. And after that, some things happened, including the attacks of 9/11. I moved back home and I decided to give people the benefit of my advice. And so I decided to switch from the institutional side, where I'd been working, to the retail side. And what I found was that after working for two of the larger retail firms, they weren't interested in performance. So they were interested in sales. And that really disappointed me because I know that when the institutions look at their portfolio performance, they get certain metrics that they know exactly what the value add of their investment advisor is. But all that disappears on the retail side. And that's what the book's about.
Really, there are actually two sides to this. There's the institutional side, and then there's the retail side. And the street is an exceedingly complex animal operation and all of those things. But you were greatly disappointed during your career, as you say, as a financial advisor. It just, you walked away from it essentially.
I did. I walked away from it. And part of it, was, I'll tell you, it was quite the day. I lived down here in Texas and I lived on Galveston Island at the time. And I'm driving back the day after Hurricane Ike. And Hurricane Ike took out the first floor of my house. And as I'm driving back, avoiding boats that are littering the highway, I hear on the radio that Bank of America bought Merrill Lynch the day before. And I just got crushed because essentially I lost my job and my house in 24 hours. I had only been with Merrill Lynch a couple of years, but I knew that when Bank of America purchased them, the first thing they were going to do was purge as many bodies as possible because they are more geared towards technology than they are the human factor. And I was right. That was September, and I was let go 4 months later in January. But I do want to say that in their defense, Merrill Lynch and Bank of America treated everybody who was impacted by the hurricane very well.
What year was this?
This was 2008.
Okay, so that was around the time of the financial crisis. So you had a career, a brief career, at what was then Merrill Lynch. You worked at UBS for a
I
while.
worked at UBS prior to that in Northern Virginia. That was quite the experience. And one of my favorite stories about retail wealth management I tell from UBS. I'm a trainee despite the fact I had a master's degree in financial markets and despite the fact I have many years of institutional work underneath my belt. They put me in the training program, send me to New Jersey to listen to their experts, and the highlight is a speech by the CEO of UBS. Well, he comes in predictably late, and he tells the audience, "I'm sorry I'm late, but I was on the phone with our largest producer out in New Mexico." And he says that when the markets go up, this producer's clients don't benefit as much as they would if they were in the markets. And when the markets go down, the clients are punished more than what the market should punish a typical portfolio. So he was telling us basically this financial advisor was selecting his own securities and not doing a very good job of it. But at the end, he looks at 400 people in the audience, shrugs his shoulders, and says, "Well, what can I do?" And everybody laughed. And I sat there and said, what can you do? You're the CEO of the largest wealth management complex, one of them in America. Why can't you tell this guy to do what he should for the benefit of his clients? And as I learned in the retail world, it's not about portfolio performance. It's about how much money you bring in the door. And Wall Street marketing works very hard to prevent their clients from understanding exactly what value is brought by the financial advisor. And that's where, this book hopes to lift the veil on Wall Street's marketing, to show that it's more than just a friendly face that you want to see. If you're paying this person a percentage of assets under management, you want to see performance. You get that on the institutional side. You get the reports that tell you how much value is added by the advice. There are only two ways in a non-taxable account that investment advisors can add value: timing or security selection. That's it. So what I always tell people is, does your advisor add value by timing or security selection? And they look at me with a blank face, because this kind of thing is never spoken to the client unless the client brings it up. And then they get all these studies that say, well, you can't really do that and you can't beat the indexes and timing doesn't work. And truthfully, most of those studies are really flawed.
Yeah. So, well, let's go back to the beginning, and this will explain some of your motivation also for writing your new book, Wall Street's Grand Deception. First and foremost, you say, as you will read, the genesis of this book and my wealth management career was the suicide of your younger 18-year-old brother. The reasons behind his suicide are what catapulted me into this industry. I hope to change it for the better. Needless to say, that was a quixotic effort. That was a tragic time in your family's life, financially, and losing your brother. More importantly, nobody wants to lose a family member in those terrible circumstances. Can you take us through that, Norm?
Sure. It's back in the 1970s. A broker from Wheat First Securities got hold of my father, who was a very successful physician in Northern Virginia, and he convinced my dad to bring my father's retirement account to him. And this was the time of the gold and silver boom. And essentially, he convinced my father to get long the silver's futures market. And Dad started off well, but then, as we all know, the bubble popped, and Dad rode that down at the suggestion of the broker. He virtually wiped my dad out. I mean, we were really, really close to declaring bankruptcy, and put tremendous strain on our family. And as you know, financial stress does not do good things in a family situation. And I didn't realize it at the time, nor did my parents, but the stress on the family manifested, and unfortunately my brother internalized it. And I came home one night, and after I was requested to by my dad, because they were going out, but my brother was there, and my brother wouldn't open the door. And I broke it down and I found it. And none of us knew that he had this, incredible pain that he was dealing with. And truthfully, I send it back to that broker who acted so irresponsibly, towards my father's account, and put all that financial stress on our family. I believe that absent that stress, my brother would still be alive today. And years later, after I became more familiar with the industry, I went back to my parents and said, we can still go after the brokerage for what they did, because it was clear, from what I had learned in the industry, it was clear that they had acted fraudulently and illegally. And my parents wanted to put it all behind them, which, who can blame them? But I still harbor, a deep resentment, as you can imagine, over all that. How could a broker not be supervised, even in the 1970s, to the point where he virtually wipes out your client? And that served as the motivation for me to get into the wealth management industry. and it's something I've always kept inside as my motivation to help people, grow their wealth. I'm out of that now because I don't like the sales side of it. It's uh, it's a part of the industry that I think really needs to be addressed. And there's a reason that often you get a lot of polling out, and financial advisors, kind of sometimes rank above lawyers in terms of industries that are not held in high regard.
Mm. Well, it's about asset accumulation, assets under management, and not about performance as it should be. So, a good skilled financial advisor is gold, and there are some out there,
Absolutely.
and you're not beating up on the good ones, clearly. But I don't want to bring up the pain too much here, but your family's finances were wiped out because of that investment your dad took from that snake oil salesman, for want of another description.
Yes,
Uh,
absolutely.
what are we talking about? Can you? I mean,
It was well into six figures. It was
mm,
well into six figures.
mm. And what's amazing here is that your dad had a very successful career. He was an educated person in the medical profession.
Yes.
Um, I've seen that before. I've done stories on really sophisticated, well-educated professionals who have no clue of finances or of Wall Street and have been wiped out.
A lot of people who are very intelligent have a fatal flaw, and that is that they believe their intelligence can port to other industries. And they say, well, this is just a bunch of numbers. I can figure this out. And they have all these studies that, prove whatever they want them to prove. And when you combine intelligence with a little bit of arrogance and a pile of studies, bad things can happen in financial markets. And like you said, you've seen that. There are very few industries in this world that are as humbling as the financial markets.
Those investors with a lot of wealth are often classified as accredited investors, right? And
Yes.
these are the same investors that will be wined and dined and charmed by very successful financial advisors, as they're known as today. And they're no longer called brokers. That's another section of your book. And of course, the charts will be proffered, over a very enjoyable, luxurious dinner, right?
Right.
And they will show the performance of stocks over the long term and this thing and that investment. And in theory, it all looks so good.
In theory, it always looks good. And unfortunately, the regulators don't play as strong a hand as they could. I'll give you a really good example. There are two standards for advertising. One is the SEC market rule, and the other is GIPS. Now, GIPS stands for Global Investment Performance Standards. Those standards say that when you show a client a portfolio, that you must include fees and expenses in order for the client to learn an accurate performance of your past trading. On the market, on the SEC market rule, you do not have to include fees and expenses when you show clients any past performance. It's a standard that belies logic, truthfully. And one of the first things I tell people in the book, other than asking the advisor how they provide value, is it through security selection or market timing, is ask them if they have a global investment performance standard audited track record. If they don't, move on. And kind of spoiling the ending here, they're very hard to come by. Advisors would rather rely on sales than portfolio performance.
So it's all about sales and asset accumulation. There's three interesting takeaways in your book. A skilled financial advisor is your best asset. So you're defending good financial advisors. Wall
Yes,
Street
absolutely.
firms are a for-profit business. Okay, I'll give them a good score on that. We're all running a business. It's free enterprise. Accordingly, their marketing departments bend the truth to suit the firm's bottom line. They're your words. And finally, having your advisor or their firm produce an investment performance report is a blatant conflict of interest, and then you go on to talk about the best way to go about that. It's a really interesting read, because you were in the industry and you've worked in London, and you've a lot of skills that you bring to this, and you have a very compelling and sad personal story. I never read the book, but the title seems to ring a bell, and I'm going to pick it up or order it on Amazon. It's a book, I believe it's actually from 1955, Where Are the Customers' Yachts?
Yes.
By Fred, how do I pronounce his surname? Fred Schwed or
Fred
Jr.?
Schwed. I'm not sure how you pronounce it, but it's a classic investment book, essentially saying, if you believe Wall Street marketing, all these clients should be very wealthy, yet they're not. And there is an ad that perfectly encapsulates this, which drives me insane when I saw it. And it is of a couple, about my age, your age, and they're sitting on a hill overlooking a lake. And they're talking to each other about how wonderful the retirement's going to be, when they can finally build a house on that plot of land they bought next to the lake. And the camera widens out, and the financial advisor sitting next to them. And the financial advisor says, I think if we move a few things around, we can make that happen sooner. Are you kidding me? This is how they want to sell their services, by this, lovey-dovey, fuzzy-wuzzy advertising. The advisor is sitting there and telling them that he can improve the performance of their account. Why wasn't he doing that last year? And by what measure does he have that he can do that with success? Has he done it before? That kind of thing never flies on the institutional side. On the institutional side, they will put out an RFP, request for proposal, from managers, and they'll have small cap managers, distressed bond managers, currency managers, and they will bring in 3 or 4 and interview them. And if you are granted money, if you are granted the assets to manage, daily, they download your performance, and they review it basically quarterly. And if your performance is not what it was before you got the money, in other words, if your performance was not what they expected, you'll get a phone call. And then if your performance continues to slip, the institution will call up, say, sorry, it's not working out. It's just business. Send us our money back. Contrast that to the retail side, where you walk into a financial advisor's office. They do not show you a track record of their investment performance. And they basically try to sell you on their personality and the cachet of the firm they work with. Couldn't be 2 different standards. Financial advisors perform a valued service. I always tell people to get a financial advisor. It's kind of like saying, how do I lose weight? Well, are you more likely to lose weight if I give you a fitness coach and a chef to prepare nutritious meals? Or are you more likely to lose weight if I just hand you a book? The answer's obvious. Coaching works. That's why professional athletes use coaches. The same thing with investments. Financial advisors who are skilled will absolutely benefit your portfolio. And financial advisors like to show a Vanguard study, and this is where studies get really interesting. A Vanguard study showed that on average, a financial advisor will add about 3% to the portfolio. But you know something, John? They didn't use real portfolios. It was all fiction. They created all the numbers on what they thought, would work. And truthfully, there is no repository.
There, Norm. By that standard, then that was fraud they committed.
That's not that's a legal standard, but I think when you put a study out there or a portfolio performance and it's not based on actual real portfolios, that should be a watermark across every page. Kind of like when you see top secret, in the movies, when people are looking at top secret documents, they have top secret. Yeah. Well, these studies should say, well, these aren't real numbers, but these are our best guesstimates by experts.
So they made, I don't want to spend too much time on this, but they made up these numbers, or they pulled them. There has to be some apples to apples to make them look, to make the company look legit, I guess.
Yeah, well, experts did put these together, but why would you have experts put the numbers together when you have millions of actual portfolios you can use? Why would you do that?
Mm-hmm. Yeah, yeah. Well, you get into an interesting psychology, I guess, of Wall Street. Emotions and sales go hand in glove. So it's all about emotions in many ways, and that's, as you referenced, the commercial. It's all about an emotional experience. It's not about performance or sales. Um, there are some firms out there, it seems, trying to walk a straight line on this now. In other words, they're coming out with ads saying, you will only pay us when we perform for you, in essence. What do you make of those?
People don't know this, but if you are of sufficient means, you can share profits with your investment advisor. Most investment advisors will tell you that that's not legal. It actually is legal, but you have to be of a certain stature financially for it to happen.
Mm.
And I maintain that if you are providing somebody a percentage of your wealth and a percentage of your wealth on an annual
Mm.
basis, they sure as heck had better outperform an index fund that you can buy from Vanguard for 25 basis points a year. Why in the world are you paying somebody 1% or 1.5% on $1 million retirement policy when they aren't telling you that they are adding value to your account? Pay them in commissions. It's going to be much less expensive, and truthfully, by their own words, they're going to give you the same advice.
Well, of course, a lot of employees, although not a ton, by the metrics and the stats, have 401k accounts at work, and basically they bypass the broker. They're not going to Wall Street.
Right. And the Department of Labor tried to do something about the advice on 401k. And then a senator from South Carolina, or the congressman from South Carolina, actually delayed the rule for 2 years. And by the time the rule got to court, it was challenged and they had to pull it back. And it's been a complete fiasco on 401k.
Yeah.
But yeah, 401ks were essentially something that was brought up in the 70s, and they exploded. Financial advisors hate 401ks because essentially the 401k plan provider only has to market to the business, and the investable assets bypass the financial advisor and go straight into their competitor. The other thing is that when you're on a 401k and you're speaking to the person who's selling it to you, you should ask them exactly what repercussions there are if their performance doesn't hold up to the asset allocation model that they've been assigned, and get it in writing. I don't think they'll do it, but you can try.
Yeah, you keep mentioning get everything in writing. Just on that, I'm curious to your thoughts. Back in the day, a lot of American companies gave their workers on retirement a pension for life, as it were. The old-fashioned defined benefit or
Right.
pension. That's pretty much gone.
Yes.
Is there a case to be made to bring that back? I know it has a lot of downsides, but it's a huge amount of upsides for workers.
I think there is. I really do. And what they have to be careful about, where pensions went wrong, is where they got overly generous. And when you get an overly generous pension fund, that means your performance or your contributions have to do better. And in industries where the pool of workers is shrinking, it's especially important to not increase benefits. Benefits from these lifelong pension funds should really cover your basics and a little bit more. As soon as they start going too far in order to gain votes, essentially is what happened, or
Yeah.
gain labor concessions, that's when the pensions start running into trouble. So it's funny because when the workers advocate for better pension benefits, they're actually advocating against their own interests.
Yeah, yeah. Well, it's worthy of another episode. Maybe we'll have you back and we'll talk about that. Because 401ks are getting beaten up right now, as we notice, with the plunge in the markets down 25% year to date, something like that, and probably has a ways to go. Who knows? So anybody retiring now is seen, unless if they were smart, they diversified another buzzword of Wall Street, and maybe their losses won't be so bad. But it raises a lot of troubling issues, really, at the end of the day, which is amazes me actually. A lot of Americans are really retired on their Social Security. That's the reality for a huge amount of Americans. It's not Wall Street money.
No, you're right. A lot of people are retired on their Social Security, and Social Security is, guess what? Bankrupt.
Yeah,
If you look at what is called, and very few people understand this concept, and I'm not going to get political. This is factual, and it's to correct a misunderstanding. If you look at the last 50 years since maybe 1972, not once have we had a year that the debt has not increased.
yeah,
And people say, well, wait a second, Bill Clinton, decreased the deficit. We actually had a surplus.
yeah,
Not the case. Go back and look at the debt levels, because when they reference the Bill Clinton, I guess it was 1999, 1998, the year where we actually had pretty good tax policy, pretty good fiscal policy, they neglect to include what's called intergovernmental debt. And intergovernmental debt has a lot of the Social Security IOUs in it.
yeah.
So if you want to see the last time we actually ran a surplus in our budget, you have to look at the debt levels. And I think that goes back to 1971 or something was the last time we actually had a surplus.
Yeah, well, only because we can print our own dollars and we're the reserve currency. If we couldn't, we'd be in a whole hell of a lot more trouble. Yeah, I mean, Social Security, by definition, is bankrupt, and Medicare and a lot of other programs, and we do have to. I'm with you on that. We have to manage our debt. You don't hear many people, politicians, now talking about modern monetary theory, because right now it doesn't seem to be working so well.
No, you don't. But I'll tell you two things. Modern monetary theory was going to be the most talked about thing in 2019, 2020 until COVID hit. Then it kind of went away, and the topic was COVID everywhere, because that was the framing of the 2020 election.
Yeah.
You can pretty much look at that now and say, okay, that's not going to work. But John, let me direct your attention to something else. You've heard of modern portfolio theory.
Yes.
Modern portfolio theory, has a few questions of it on your Series 7 exams, et cetera, et cetera. Do you know when modern portfolio theory was first put forward? 1956.
Hmm.
Okay, how modern is that? And one of the key tenets of modern portfolio theory is the use of uncorrelated assets. Now, I defy anybody to come into my office and show me an uncorrelated asset these days that I can expand over $100 million portfolio. Where are the uncorrelated assets?
Mm. Yeah, right.
So modern portfolio theory.
Yeah, and just for a broader audience that may be listening to this, just give us a quick education on this. Who does this benefit and does not benefit? Institution versus retail. Why should we be worried?
That's a great question, John. You should be worried because as I described in the book, Wall Street's Grand Deception, portfolio performance reporting for institutional clients is vastly different than portfolio reporting for the retail client.
Yeah.
So even though there are very few, if any, uncorrelated assets these days, institutions can absolutely identify if their investment advisor is adding value. Retail investors can't.
Yeah. Yeah.
And who wants to have a performance report? And studies show that people raise their eyebrows at this and think it's not fair. Who wants to have a performance report that's produced by the person that you're grading?
Yeah, yeah, no, that's
sense.
very clear in the book, and it's a sham in a sense what you're saying. And then for the institutions which have the resources and can make these demands on those handling their portfolios on the trading desks, etc., they get a real granular account of how everything is going. They get this so-called alpha, this so-called beta, and it's broken up into chunks, and you can, it's time sequenced, and it's really in-depth, and they can see if they're being screwed around, I suppose.
Absolutely. And And I'll tell you a trick that retail financial advisors do, because they are able to produce performance reports of different lengths, sometimes just a summary, sometimes the summary with a few notes, but sometimes they can produce a performance report that's a clear inch thick on a very simple account.
Mm-hmm.
And a lot of financial advisors produce the really big report because they hand it to the client, knowing the client's going to look at that, not want to take the time and effort, and just look back at the financial advisor and say, I trust you. Just tell me what's in it. And
Yeah.
it's the worst thing that you can do.
Yeah. Back to your book, Wall Street's Grand Deception. There's a very interesting analysis on the bonus gravy train. In other words, these multi-million dollar producers, they call them producers, and they'll get scooped up by another firm and given a massive bonus. And it's never always that simple. But you think that practice has corrupted the whole business model?
It has. I know it has. And I'll give you a first person account of it. When I was at one of my broker dealers, I watched a very successful group come into the office, and they had been hired away using a bonus structure that you described. And the bonuses usually take the form of a loan. So they'll give these financial advisors a very large loan that has great terms, and they sell the financial advisors to switch firms by saying, you can really use, if your practice continues to grow the way it has, you can use the revenues from your practice to pay the loans directly. So a lot of these financial advisors are getting 7, sometimes even 8-figure loans to change firms. And I watched one group come in who had received a 7-figure loan from a very well-known broker dealer. They came in and immediately switched everybody in their book from low-cost mutual funds to high-cost, high-revenue hedge fund products. And I just sat there with my mouth open. What got them there? They were completely prostituting themselves and doing a great disservice to the client. But that's the way that a lot of these financial advisors figure out how to pay their loans back early, is by switching their existing client base, who trust them greatly, into higher commission products.
Yeah, and that helps them satisfy the demands on them from corporate. So they're forgivable loans, as it were. So you have to reach a threshold, and it gradually you pay back the company. But if you meet those thresholds, you have $1 million bonus in effect.
Right, exactly. And I'll give you another way that the system is gamed. A lot of media put out top financial advisor lists. And it's really interesting, and they stopped doing it. Some of them stopped doing it. But if you look at the ones that were done a year, 2, 3 years ago, first of all, they will tell you in the fine print, portfolio performance is not part of the ranking. However, the asset size you manage, the touchy-feely, fuzzy-wuzzy stuff we get back from your clients, and the amount of revenue you generate for your firm are all considerations. Can you imagine hiring a lawyer based on how much he bills his clients? That's what these rankings are telling us. Further, since when can portfolio performance not be a determinant of who the best financial advisors are? It's insane. And if you look at the lists, the ones that rank high always have more assets under management than the ones that rank low. You know why that is, John? Because who is going to license from that company the list to put in their advertisements? Would you rather have a company with $1 billion under management licensing that list from you to show their clients in an advertisement, or a company that has, let's say $50 million under assets? Obviously, the one with $1 billion in assets has a much bigger marketing budget to use. So that's why, in my opinion, you always see the big time producers at the top of these lists. They have more money to license these lists and use them as advertising.
And there's nothing about their performance over their history of their career. And the other thing about these multi-million dollar bonuses, in some cases, a financial advisor who can't meet the demand sometimes ends up
They're
getting
fired.
they're fired. And you mentioned at least one instance in the book of somebody who's now an Uber driver or selling pizza.
Yeah, he was
His
fired.
career was trashed.
His career was trashed, and it goes beyond that. These broker dealers can actually come after you legally and get a judgment, a monetary judgment against you.
Mm.
So the pressure is quite real. You not only will lose your job if you don't produce, but they will come after you for the money that they gave you in that low interest term friendly loan. It's bad news, and the broker dealers should really be ashamed of themselves. They laud it when they bring brokers over or financial advisors over from another firm, but there's a real dark side to it.
Yeah, and then there's all these lawsuits and litigations and arbitration.
Yeah.
That's a whole other side to it. If you look across the landscape, all the big wirehouses, as they're often called today as well, and or brokerage houses and so on, they keep changing names every so often. Um, would you say the majority of financial advisors out there are good and ethical? Any way to kind of sum that up?
I would absolutely say the majority are ethical. I have no problem saying that. Are they good? I'm going to hedge my bets a little bit there. And the main reason is even they don't know if they're any good.
Mm.
You know, they service the client. They do things that a financial advisor should do, asset allocation modeling, investment management, estate planning, insurances, and all of those things are valuable. But all of those things, like when you hire a lawyer or accountant, should be charged on an hourly basis. If you are going to be giving a percentage of your assets away, you should know the performance of the portfolio, period.
Yeah. So you're saying also these skilled financial advisors have to be another kind of a cliche, but holistic approach. In other words, be able to really go granular on performance and what you're invested in, uh, offer tax strategy um, ideas, and really hold your hand and be on their game.
Absolutely. As you pointed out earlier in the program, a lot of people really don't understand the financial markets and really don't understand how to handle their money for when they're going to need it in their non-revenue producing years. Those are the benefits of hiring a financial advisor,
Yeah.
and they need to be compensated for that. Everybody gets paid in this industry. Everybody gets paid in every other industry. They need to get paid too. But my point is if you're going to pay somebody a percentage of your assets, they better perform on the investment management side. Otherwise, go to commission at an hourly rate.
There's a great anecdote story you tell at the start of the book about when you had to come to New York and you met up with a senior muckety muck at the Harvard Club, and he was high level, and your jaw dropped in conversation because he shared something with you which had you dumbfounded.
Yeah, we were meeting with a with actually I'll go ahead and say we were meeting with Jack Schwager, the guy who wrote the Market Wizards.
Okay.
And this person was a very high rated in Goldman Sachs. And as we're talking and having lunch, the person looks at me and goes, "So, how does your portfolio perform?" And I told him the truth. I usually do very well at missing, market downturns. I really stink at catching market upturns. And I said, "Well, how do you do?" And they said, "Let me tell you a story. I thought I was doing really well, and then I took my portfolio returns and ran them through our internal analysis software. And it turns out I'm really horrible at it. So after work one day, I went down the street to a financial advisory firm, opened an account there, and now they handle everything, and I'm doing much better." And this person was educated in finance to the extremes, which goes to show you it's not only about a mathematical edge, your trading ability. A lot of it is psychological because this person had the ability, as was demonstrated, to invest billions of dollars in a way that put them at the top of their industry. But on their own account, their brain betrayed them, their intellect betrayed them, and they knew they were better off with another person handling their personal account.
Amazing. What do you make of today's markets? We've 25% decline from the start of the year. It doesn't look very good with high inflation, more interest rates coming, just the whole geopolitics, war in Ukraine, and a political war over natural resources.
Sure. Well, let's take it back to 2008 and QE. And that really started this because when you started QE and you continued in QE and essentially expanding the Fed's balance sheet, what ended up happening was you broke the price discovery process. And for those of you who don't understand price discovery, it's real simple idea. And I'll go to eBay. Let's say you pick up a shirt in your closet and you've never worn it. It's an expensive shirt and you want to sell it to raise some cash. Well, you got to start knocking on doors. Then eBay comes along. Well, now you have thousands of eyes on this shirt and they're all bidding for it. That's price discovery. You put the shirt out into the market and you got a true market price because it was free for everybody to bid on. So you know what your shirt's worth. When you mess with interest rates because you don't want market equity or debt markets to suffer and you don't want asset sheet balances to suffer, the Fed put us basically at zero interest rates, which basically broke the price discovery mechanism. And we have to figure out what prices are again. And that's not going to happen, I think, for quite some many years to come. And when Putin invaded Ukraine, anybody could have seen what was going to come afterwards. Like I said, I'm pretty good at spotting market downturns. And I know from my time in Greece and listening to my relatives in Greece that Ukraine exported grain essentially to Europe. Most of Europe experienced Ukrainian grain. And when that was interrupted, now you know the grain markets are going to suffer. And on top of that, we had an administration which decided to inhibit our domestic energies production abilities. It's not good. And John, I wish I could tell you when it's going to end. I don't know. It's going to be many years. That's not to say the market might not come back for many years, but I would point people to other markets such as the Nikkei, which had a 15-year down in the equity markets. And it's turned out in the debt markets too, which I believe for the first time since 1961 are performing worse than the equity markets in a downturn.
Yeah, it's amazing. Yeah, truly amazing. And I mean, there's so many ways you could just dig deep into this whole Wall Street machine and the wealth management model. I mean, even stock picking, because you have a section in your book about just basically stocks that were trash and were sold to investors over the years. And I guess in theory and in reality, we're still doing that on some. There are companies out there that have no earnings except a good story, and there are companies out there who have great earnings but just lousy story or lousy marketing, and the company with no earnings and no future is outperforming the market. Quite bizarre.
It is quite bizarre. And what you allude to in all of that is really the need for a financial advisor who is skilled to get your hand and wade you through this, because we're not looking at a 1-2 year horizon for your retirement. We're looking for a 10, 20, 30-year horizon for your retirement, which is why when all of these things bubble to the surface in the media and you think that that must be the way to go, when what they really are is shiny, flashy things that you really need to stay away from. That said, why in the world would a investment firm still have a buy on Enron the day after the fraud was revealed? And that happened. That really happened. People were still trying to buy Lehman. People were still trying to buy Enron. I sometimes wonder, how deficient people are in math and logic.
Yeah.
And
it truly, I mean, then you could just go through the whole .com boom and bust and how
Bitcoin.
Financial advisors were on the front line of peddling those stocks, and you had analysts writing up glowing reports. But that's maybe for another episode, Norm, because the name of your book here is Wall Street's Grand Deception. Can you just a quick, again, summary summary advice, if you will, for
Sure.
the regular consumer, what they should be aware of, how to pick financial advisors, and how not to get scammed. It doesn't mean they're going to be millionaires, even if they do the right thing, but at least they'll protect themselves in a better and sounder way, we hope.
Sure. Yeah, you're absolutely right. A financial advisor is not going to get you rich. The only thing that is going to get you rich is your job. So let's get that out of the way. This book is not about bashing financial advisors because a good financial advisor is an investor's best asset. However, before you hire a financial advisor, you really need to take the time to do your due diligence. And by that, you should, of course, investigate their regulatory background to make sure that they don't have any red flags. But you also need to find out if they're skilled. Do they have a track record that's been audited and verified? One of the tricks I give, and it's going to take a little bit of gumption to do it, is have them pull up their Amazon account and see what books they buy. Because I promise you this, John, if you go on Facebook or you go on a web search engine and you start going, become a better financial advisor, and I've done this, your Facebook page starts getting populated with ads on how to get clients, not how to perform better on the portfolios that you manage. So has your financial advisor been buying books to educate them on the market, on economics, or has your financial advisor been buying books on how to get more clients? That's the first thing I would say. The second thing I would say is that if they cannot prove a financial track record, but there's somebody that you like and you think you can trust, go on commission first. Do not pay assets under management. And you tell them that you are going to be using a third-party portfolio performance reporting provider like we are developing at financialadvisorcheck.com.
That's your
And
company.
that's my company. We are providing the world's first third-party objective portfolio performance reporting app. And we're in beta now. If you want to be a beta tester, you can go to financialadvisorcheck.com and sign up to be a beta tester. But essentially, if your financial advisor does very well, show them the report. They will love it because their own company doesn't tell them if they have investing skill or not. Their own company only counts how much assets come in the door and how much they generate in revenue. And if you do have a financial advisor that is good, tell your friends, make the referrals. If you have a financial advisor that you believe is wanting, look at them and say, we're really going to have to address our compensation program until your returns and your performance come back into line with things that where I believe they should be.
Well, we're not here to endorse your company, but give us the name one more time and your website, any other contact details.
Sure. The name of the book is Wall Street's Grand Deception. The name of the company is financialadvisorcheck.com.
Norman Pappous, thank you for being on my show.
Thank you, John.